Hello, welcome to my channel, Data-Driven Decisions. And I'm going to talk about investing today, and I'm going to show what my performance looks like over these past 3-4 years. Um, you know, all in all, I'm a simple investor. I just believe in getting my fair share. I don't have rock solid stock performance, but as I'll show you, with a mixed asset allocation, if you put bonds in the mix, um, I'm right in line with a mixed portfolio index. So basically, I'm just getting my fair share. Um, Let me share my screen and I'll show you. So what we're looking at is starting from June of 2021 to present. So about 3 years of history. It shows my performance in comparison to a blended index fund in orange. So my blue and the orange, you see how they are very much in sync. So I'm getting my fair share. This basket, I kind of showed this how I built this portfolio in a prior video. I just mapped out the performance and the risk of about 550 portfolios from experts using Portfolio Einstein. I picked the 20 best ones, and most of those portfolios had fixed income in it. Because most financial advisors, even when you're young at my age, 36, looking back, let's compare it to U.S. stock. You can see how I'm very underperformed on that realm, sadly. Um, over the past year, there's really been a big difference between my portfolio and the stock. And if we just go over to bond, it's really been sad what has happened to bonds. I bet it makes a comeback, though. It looks like it is lately. Bonds are still important. What I actually did probably back in 2022, after, this is not smart, but after this loss of bonds, I mean, I was just losing my ass in bonds. Everybody was. I sold them all off, and I now have a all stock portfolio. I sold all the bonds, and I just bought VTI, the main ones. So that portfolio I have now, which was the average of 20 expert portfolios, it's not true to that. It's, looking back, your worst enemy is yourself. It's panicking after large losses, and I was guilty of that with bonds. I don't think it was a smart decision. I think I need to uh, go back to the original asset allocation of my Vanguard. We're just looking at my rollover 401k. So this money I haven't really put into it in 5 years, so it's just market return. There's nothing going into it, and it's a big chunk of money that I'm managing myself, and I like it. But yeah, definitely, the moral of the story is, I systematically picked a portfolio that was very much now it really is just your typical blended portfolio as given by Personal Capital or probably by any finance institution. This index, I am right in line with that. Um, you know, Despite selling my bonds a couple years ago, which I don't think was a good decision, but it wasn't a terrible decision. In the course of my 10 years of investing, in the beginning, I was very scattered. I made huge mistakes selling and panicking after huge losses. I had no clue what I was doing. I wasn't playing with a lot of money. I was only playing with like hundreds of dollars. At that time I was in student loan debt. I didn't have money, and I knew first step was to get out of debt before I really seriously invested. Um, I'm guilty of making all those stupid amateur mistakes. But what I'm most proud of is I think in the past 3-4 years I've barely have changed my plans of investing or my asset allocations of my current um, accounts, despite the bond selling. I mean, that's the only thing I've done. Um, that's wisdom right there, that I'm accumulating just by no longer being a rookie, but kind of being an intermediate. I don't know. I don't think I'm an expert. There's financial advisors; those are experts. I'm just a business intelligence engineer. But after reading so many books about the danger of trying to seek financial help from financial advisors and knowing that they're going to siphon off a lot of your money, I'm truly a do-it-yourself kind of guy. Um, you know, how are you going to be able to find the real angels in the industry, that truly are fiduciaries that are going to get you in index funds that are, um, you know, really going to do the right thing with your money? You know, I I have a good friend who um, is that way, and he made a book, and I'm reading it. It's awesome. Um, they're out there, the people that really are going to be fiduciaries with your money, and not take too much out. Take their fair share out. It shouldn't be a lot. It should be significantly less than what they take out in active management. I think less than 1% it should be. But if you're a do-it-yourself kind of guy, um, you lose the benefits of having a coach who can steer you, in a great direction. But you get to invest at rock bottom prices. Um, my expense ratio is probably like zero point 0.2 overall. There's not a single expensive fund that I'm in. Everything is an index. It's an ETF. Rock bottom prices. Most of it is Vanguard. I like Vanguard the most. I trust it. It's you know if you read so many books, sadly most people don't read books. It's okay. I just made the choice to do it, and I'm really thankful for it because if you read the books about investing, they're out there, and it's been around for 30 years. Jack Bogle, William Bernstein, Burton Malkiel, Charlie Ellis. I mean, this is just a camp of kind of guys, and they're really big empire type finance guys, and they really called bullshit on the whole system and saying that the markets are efficient and nobody really can consistently outperform the market. Nobody really has. Um, but all in all, if you're not aware of um, the market or just of the system, that you can't consistently beat the market. You shouldn't even try. If you try, you're going to pay about 3 or 4% in expense ratio fees. So you're going to get probably the market average because if you sum up all active management, they're going to receive the market average. So just, average what you think you'll get, and it's going to be the average. They're going to sell you and say, hey, no, we always beat the market, we do it year over year. It's not true. And, if they truly have had positive returns for the past 2 years, that's more reason not to get on board, because reversion to the mean, they're going to reverse back to gravity, probably underperform the market for a couple of years, especially if it's a popular account. When a fund has a good 10-year track record, something like that, it then gets asset bloat, where every trade it makes is a huge impact on the market price. And for that reason, since they're always going to move, every trade that a big fund has to make, since it's dealing with huge quantities, it's going to impact the price every trade it makes, and that's going to impact it negatively. When it needs to sell, it's going to have to sell at a lower price, and when it needs to buy, it's going to have to buy at a higher price, just to make up for the impact of that huge trade. If you're just a nobody like me, or somebody with less than $1 million, you're nothing, so you don't have to deal with that. There's no cash drag on your trades. You're a couple $1,000s is nothing. If you're talking tens of millions of dollars, then I think it's something. But I truly believe just getting your market share. I think in a future video, I'm going to show you how I'm going to just readjust my asset allocation back to bonds. I think now's a good time to get on bonds. The storm probably is over. I think interest rates are going to decrease. They just started to. Let's go back to U.S. bonds. It's making a positive return lately. I think now, I wish I was on board. I wish I always stayed on board. The time I sold, it really hasn't decreased. It's increased. So I think it's time to get back to the normal asset allocation. Just get my fair share of the blended. But I am starting to realize I need to be more stock heavy. So, I'm young. I got 25 years before I want to retire, maybe more. So, I want, bad years so that I can buy things on the cheap. So, yeah. So, yeah, I truly, I think I want to be more stock heavy than what, these experts are telling me. Um, you know, I've said in other videos, if you're new to investing, just put all your money in VTI. If you did that, that's what you would get. It's a rockier ride. An all stock portfolio is going to be rocky. When it loses, it can lose big, and you can't panic. You got to stay on board. But the rewards are there, and look at it. It's like triple, double what a blended is. So, duly noted. I don't want to be too conservative. I think maybe this is too conservative. I've only received a 14% gain in 2-3 years. When the U.S. stock market has made like a 28% gain. So I've lost half of what I could have gotten if I was all stock. So, I'm learning. I think I need a rockier roller coaster. I need to really do what I preach. I think I always thought that a more sophisticated portfolio would be better, but it's not. I think just VTI alone is perfect diversification. You can't get any more diversified than that. So why alter it in any way? So just go all VTI. There's also the 3-fund lazy portfolio, which is total stock market index, total bond market index, and then non-US stock. And then there's the 4-fund if you want to do a U.S. or foreign bond, but most don't recommend that, So, those are definitely the best portfolios for new people, the all VTI or the lazy three. Um, you'll just get your fair share. The most important thing in investing is not to panic when times get tough. We definitely just had a pretty large market correction lately, and look at how much it's increased so far. Big time. Always after the huge avalanche comes a major uprising. Those are the biggest gains right after a big loss. So you always want to stay on board. You don't want to miss the train. And if you sell when it's going down the cliff, you're probably not going to buy before the horizon, before the uplifting. So always stay the course. And I totally did that. I haven't touched any of my asset allocations in years, just because, Jack Pogle's always said, don't do something, just sit there. It's the opposite of don't just sit there, do something. He's saying just sit there and do nothing. That's really the best piece of wisdom in investing. I think Warren Buffett's really about that too. Definitely when he dies, he wants just total stock market across the board for his inheritance, just so that that money lives on for a long time. Um, so anyway, um, you know, I hope you like this video. As you can see, I'm just getting the blended average with my stock returns, and I say that's just me getting my fair share. Um, so, I think I'm learning to be more stock heavy, you know, but all in all, I'm proud that these two graphs are so in line. It just shows that what I'm trying to do is what I'm getting. I'm just I'm truly in a blended uh, asset allocation. It is really just uh, mapping the index. So that's that. Hope you like this video. Thanks.